Welcome to our presentation on how the Investor Advisory Service newsletter can help your portfolio. In the next 30 minutes or so, I'll tell you all about one of America's top newsletters for stock research. I'll also discuss how you can leverage the robust research produced by the Investor Advisory Service to assist you in building and maintaining your personal stock portfolio. I'm your host, Doug Gerlach. I've been the editor-in-chief of the Investor Advisory Service newsletter since 2003, and I've been helping individual investors to make sense of the stock market for more than 30 years. So let's start at the beginning. What is the Investor Advisory Service? Simply put, IAS is a stock newsletter. But to be more specific, IAS is a research service that generates stock ideas for independent individual investors. We use a disciplined strategy that focuses on selecting well-managed, high-quality companies that have the potential to deliver above average total return over time. We use time-tested methods of fundamental analysis to identify stocks that fit a long-term buy and hold strategy. And what's more, our performance record backs up our approach with one of the best track records you'll find amongst stock newsletters today. The history of IAS goes back to 1973. And so we're very pleased to be celebrating our 50th anniversary here in 2023. In the financial industry, it's rare to find a publication that has persevered through the worst market downturns and economic recessions of the last 50 years, along with the explosive bull markets and economic expansions in that time period. The team of 4 chartered financial analysts who do the heavy lifting to carry out the stock analysis in the Investor Advisory Service have a combined more than 70 years of experience in the newsletter. Now I'd like to explain the basics of our fundamental approach to analyzing stocks. Our analysts use a methodology based on techniques developed in the 1940s and 50s by the nonprofit investor education group NAIC, also known as Better Investing. Their tool is known as the Stock Selection Guide, and it's the framework for identifying key attributes when considering a company as an investment. Each stock we present in the newsletter is selected to meet certain standards of growth, which is required to drive capital appreciation. Quality, to ensure management has the skills to deliver growth consistently, and value, to only buy at the right price, that all come together to allow our picks to outperform the broader market over time. First, let's take a look at growth. Earnings per share growth is required to drive long-term capital appreciation, the price growth of a stock, and sales growth is required to drive long-term earnings per share growth. Thus, we typically seek out annual growth potential of at least 10%, perhaps less for mature growth dividend payers. These historical growth trends provide a foundation for identifying candidates, but then deep research into headwinds and tailwinds provides confirmation or cause for elimination. Next, we'll consider quality. A skilled management team is able to deliver consistent fundamental growth. You can identify the strength of management by considering a few factors. Profit margins should compare well to peers and competitors. The company should not be over-leveraged. Dividends, if paid, are well supported by cash and earnings. And strong cash flow generation is always a good sign. Finally, once you've found a strong company, it's important to focus on valuation. We remain disciplined when buying, looking for price earnings ratios that are reasonable when compared to history and growth expectations. But we're not afraid to be contrarian, to take advantage of mismatches between markets' assigned value compared to our estimate of long-term prospects for a company. Our goal for each stock is to outperform the market over time. And so each selection is chosen based on its likelihood to double every 5 years, which is to say it should earn a 15% compounded annual rate of return. This total return can come from a combination of three factors. The largest of these, the most important, is capital appreciation, the growth in a stock's share price that comes from the underlying growth of the company's fundamentals, such as earnings and revenues. For companies that pay dividends, the yield can provide an extra component of return. And finally, when we're able to buy stocks at lower PE ratios than they typically sell for, we can benefit from the expansion of those PE ratios when valuations return or exceed past levels. Understanding how these three components of total return work together is important in navigating different market cycles or investing in different kinds of companies. Each stock that we present in the newsletter is selected on the basis of its projected performance over the long term, which we define as 5 years or longer. Our strategy is to hold through all market cycles, though, up, down, sideways, because it is impossible to effectively time the market. Of course, not all stocks will be covered in the newsletter for 5 years, but that's okay. We never said that we would buy and never sell. Laggards are pruned frequently from the coverage list. And many of our stocks have been under coverage for decades, including one company that was first recommended when it was an emerging small cap in the late 1970s and has been in the newsletter ever since. Our approach to analysis can be used across many different kinds and size of companies. Our coverage list includes stocks from nearly every sector and industry, only energy and utility stocks that seldom fit our model. We also cover companies of all sizes, from small to mid-size to large to mega. Smaller companies are pegged to deliver faster growth, while larger companies may provide more stable growth and/or dividends. This allows us to present a menu of ideas to help subscribers find candidates that fit their personal portfolio needs and preferences. We typically recommend stocks with different characteristics, such as both newer and mature companies, or more aggressive and more conservative picks, or dividend payers versus growth stocks. Each issue features 2 or 3 in-depth company profiles for our recommended stocks in that issue. Though these are our team's best picks for buys in that month, each subscriber is urged to do their own research and evaluate the suitability of any stock before buying. If none of the stocks in an issue is deemed suitable, we also highlight other candidates from the current coverage list of 60 or more companies that might be reasonable buy opportunities. Every featured stock is subsequently followed by our analysts with suggested buy and sell prices updated monthly in the newsletter. Occasionally, stocks may be recommended for sale, usually because of weakness in a company's fundamentals or concerns about its future potential. In other cases, stocks might reach an excessively high valuation, and our analysts will recommend the stock as a sell because of increased downside risk. But we never take a knee-jerk approach to bad news or engage in other sell strategies that usually don't serve an investor's long-term goals. With our focus on quality, we've found that the best course of action is often to hold on through periods of temporary trouble and give a company's management team the chance to set the ship back on course. Now let's take a look at what subscribers receive in each monthly issue of the Investor Advisory Service. The first section in each issue is the investment comments, with plain English explanations of the most important aspects of the economic situation and market activities as they relate practically to individual investors' portfolios. The graphs of the value of the S&P 500, treasury bills, and long-term treasuries provide a snapshot of important trends affecting equities markets and reflecting investor sentiments. This is the key market indicator section. The sale of stocks section outlines the rationale for why our analysts perceive a stock as a candidate for sale by subscribers. Sold stocks are discontinued from coverage. Each month, All of the companies that have reported quarterly or annual results or announced other important news are included in news of companies. This makes it easy to understand how a company's recent results might affect a subscriber's portfolio, or whether it might be a good idea to buy more shares or simply to hold on for now. Occasionally, issues will contain answers to questions from subscribers, announcements of events, or other news relating to the newsletter. In the earnings reports table, companies that have reported quarterly results are summarized here with the percentage change year over year. Stock splits and dividend changes are also listed here for subscribers' convenience. One very important feature of each issue is the table of company data that covers all stocks on the coverage list. This table includes recent price, dividends, earnings per share, growth rate estimates, buy and sell prices, and more. Subscribers who really like to dig into the data can download an Excel spreadsheet from the subscriber section of the website that's updated each month with current values. The website also includes a sortable and printable version of the data table, so subscribers can choose to sort the companies by projected total return, for instance, or dividend yield, and easily print out that version of the report for their personal use. But that brings us to the heart of every issue, the company recommendations. Each issue contains in-depth profiles of 2 or 3 companies, which could include entirely new companies to IAS or reiterations of past picks, whichever stocks are positioned at the time for optimal total return at the right price. The stock selection guide, or SSG, that's included for each company is a graphical representation of growth and a quick summary of key fundamentals. This form's been used by millions of investors since the 1950s to help them identify opportunities to invest in growing, well-managed businesses at the right price and maintain their discipline while they conduct their research and buy and sell decisions. The full issue of the Investor Advisory Service is published on the 4th Friday of each month. Occasionally, the Thanksgiving and Christmas holidays will adjust that schedule. During earnings seasons 4 times a year, we publish bonus interim updates that summarize the company quarterly reports that have been released since the last issue, along with updated buy-sell prices. This prevents subscribers from having to wait up to a month for updates on their followed stocks during this busy time of year. And when deemed appropriate, news alerts and sell alerts are sent to subscribers by email as well. Often it's the case that a sell recommendation will only be included in an issue. We're not trying to time the market, so much of our action can be taken in the publication of the regular issue. Now, on the IAS website, subscribers can download each month's issue in PDF format, and that they can print, they can save for future reference. But the website also includes some additional useful features, such as an issue archive going back to 2002. The archives are searchable, so you can look at the history of recommendations of a particular stock, for instance. It's got the custom and sortable and printable report of the coverage list and the downloadable Excel spreadsheet of the same. There is a basic screener of current covered companies. There's a downloadable How to Use IAS user guide that is a must for all new subscribers, as well as access to customer support to answer any questions that you might have about using the Investor Advisory Service. We've already mentioned a bit of the history about the Investor Advisory Service, so let's take a closer look at its track record, which is of course what investors are often most interested in. This graph shows the returns of the Investor Advisory Service for various periods from 1 to 20 years in the green bars compared to the S&P 500 in the orange and the Wilshire 5000 in yellow. Now, these calculations come from Hulbert Ratings, who rebalance our selections regularly and calculate the overall returns of the entire coverage list and benchmark them against those two market indexes. And you can see that the investor advisory service returns have exceeded the broader market in the last 3 years, 5 years, 10 years, 15-year, and 20-year periods, something that the majority of actively managed mutual funds and professional money managers can't do. And here is the lifetime performance as defined since 1996, when Hulbert began tracking the results and record of the investor advisory service. In that time frame, in the investor advisory service, stock picks have earned a 12.7 annualized rate of return compared to 9.5% a year for the Wilshire 5000. If you had simply indexed your portfolio, you would have trailed the investor advisory service stock picks by 33.7% on average per year. That's the kind of edge that many individual investors seek, but very few actually find on their own. And it's this kind of consistent long-term performance that's earned the investor advisory service rare accolades in the industry. For the past 13 years in a row, the Investor Advisory Service has been named to the Hulbert Investment Newsletter Honor Roll as one of the very few newsletters whose results in multiple bear and bull market cycles over the long term have always kept ahead of the broader market averages. You may not have heard of the Hulbert Investment Newsletter Honor Roll. That's because so few newsletters actually make the grade, and only one other newsletter beyond the Investor Advisory Service has been named to the newsletter every year for the last 13. But no honor roll recipient has topped the performance in 2021 or 2022 of the Investor Advisory Service. The IES was named the #1 newsletter in both of those years for total return compared to all of the other honor roll recipients. And what's more, in 2021, no newsletter in the United States performed better than the Investor Advisory Service, whether they were on the honor roll or not. So the performance track record validated by Hulbert has been exemplary over time, and we're looking forward to continuing that winning streak in both up and down markets. So now that you've learned a little bit about the Investor Advisory Service, let me tell you how you can subscribe with this special offer, and then we'll go on to talk about some stocks and answer any questions you might have. Now, if you are a member in good standing of Better Investing, then you're eligible for a special members only rate. Better Investing is the owner of the publisher of the Investor Advisory Service, and so they've extended this discount for Better Investing members. You'll find that promo code on the Better Investing website when you log into your account, or you can also call Better Investing or the Investor Advisory Service to subscribe over the phone and get more information. You can also, if you are not a Better Investing member, you can use the promo code 13 for 13 to get special savings and save $100 off an annual subscription, and that promo code will continue for the life of your subscription. You can use that promo code at the Investor Advisory Service website, www.investoradvisoryservice.com, or by calling us at 866-33-iClub during business hours to subscribe over the phone. And now, as promised, here's some recent selections from the Investor Advisory Service that I will present for your education and to illuminate some of our strategies and some of our analysis methods that we use in picking stocks. Now, these are examples only. For current buy and sell prices and other information, you'll need to consult a current issue. As always, do your own research before adding any stock to your portfolio. So first up is On Semiconductor Corporation. also known as onsemi. It's a mid-sized maker of semiconductor chips for the automotive, industrial, and other markets, including significantly electric vehicles. Here is its 10-year history. Semiconductors typically operate in their own industry cycles, as you can see in this 10-year graph of sales at the top in green, pre-tax profits in magenta, and earnings per share at the bottom in blue. So it's easy to discern the market cycles of the semiconductor industry, where some years see significant outperformance, other years see underperformance, but the long-term trend is decidedly upward. From our analyst perspective, the company's prospects in rapidly growing markets such as electric vehicles should give it an edge, but also many onsemi customers have entered into long-term supply agreements, and these long-term agreements provide a sound base for growth in the next 3 to 5 years of the company. In other words, they have agreements to provide chips for customers, and so there's a base of revenue on which they can build further business for the organization. The next selection is NICE, a maker of business software systems that allow their global user base of 25,000 organizations to more efficiently and effectively communicate with customers. They have a smaller financial crime and compliance unit that makes products that help financial institutions prevent fraud and satisfy regulators. For this company, they've been shifting from sales of applications on an enterprise basis to utilizing cloud-based software as a service. So more of the subscription tool that provides recurring revenue, and has also boosted sales growth as they're able to pivot more quickly in the cloud framework to deliver solutions for customers. This also provides a good footing for future product evolution. When we look at the graph of this company, you can see the consistent growth of sales and earnings in the past decade, somewhat atypical for such a small business, but the consistency is very attractive, and it gives our analysts greater confidence that future growth may travel along a similar pathway. And then the third selection is Perion Network, a small digital advertising company that serves both traditional internet display ads for sites like one of their major customers, Microsoft's Bing search site, but they also deliver video ads for streaming services and digital television channels, like it did for the stream broadcast of last year's FIFA World Cup that set records for streaming of athletic events globally. And you can imagine that the growth in streaming is a big driver of the company's business. When we look at their history, it's a much less mature business, perhaps, but the upward trend in the last 5 years is undeniable. And that less consistent growth is perhaps a little bit something that we trade off for the possibility for future total returns as the company matures and expands its business line. Certainly that continued growth of streaming services and the cord cutting of cable television by many traditional television customers should benefit Perion in the years ahead, to be certain. Now, all three of these companies have been selected because my sense is that you probably haven't heard of any of them. And that's what we like to discover, those small to mid-sized companies that have not yet been discovered by the broader investing or Wall Street community, that provide optimal risk and return components for individual investors. So those are 3 ideas for you to research and make your own decisions. So I'd like to thank you for watching our presentation on how the investor advisory service can help your portfolio. I look forward to welcoming you to our family of subscribers. And please use that promo code 13 for 13 at www Investor Advisory Service to start your subscription today.